Hi guys, welcome to another video by Optionables. My name is Saket, and in this video we are going to talk about something which many people have been asking us for quite some time ever since we made a 1 o'clock short straddle video. That is, how exactly do you do backtesting? And in this video I am going to tell you how to use a simple software called a Stockmock, from which you can actually end up backtesting all your option-based system strategies. Stockmark is a platform which we have been using for quite some time, and there are a lot of features in Stockmark. So before, if you actually had to backtest a strategy, so it used to cost you quite a lot, somewhere around 20 to 30,000 rupees just to get one backtesting done. But Stockmark has now got this backtesting feature to retail people, where you can just do it for as low as 5 rupees per year. So we have personally spent a lot of money to buy high-end packages from Stockmark, so the cost of backtesting is going to drop quite a lot. So now in this video we are not going to talk much about the features of Stockmark. There are a lot of features in Stockmark which you can figure it out yourself. So this is a basic video where we are going to focus on two main aspects. So the first aspect is, if you're new to Stockmark, how exactly to just add your strategy and backtest, and it is quite common for everybody. The second aspect is where it is going to help a lot of people who have already been using Stockmark also. So this is, let's say I give you 10 different strategies. So you're going to get 10 different results, different probability of profit, different overall profit. So how to pick the best one among these 10? So that is what we are going to discuss, and it is pretty simple to do that, and I'm pretty sure all of you would enjoy this as well. Next, there is also a link in the description below to register for Stockmark. If you actually use Stockmark using that link, you will be getting double the free credits what you get if you don't use this link. That means if you go to Stockmark on your own, you will be getting a certain number of free credits. But if you use Optionables link down in the description, you will be getting double the free credits. So don't forget to check that offer out as well. And finally, you can also open an account with Firstock and get 100 free orders worth 2000 rupees. So this is just the first part of the video. In the upcoming videos, we are also going to learn about further features as well as different things regarding Stockmark and how to use it. So if you are liking the content on this channel, then don't forget to hit the like button, share this video, as well as subscribe to Optionables. Thank you so much for joining, guys. So this is the home page of Stockmark. So whenever you open Stockmark, you will be landing on to this page. And as I already told you earlier, so in this video, we are mainly going to cover how to do simple backtesting using Stockmark, how to understand the data which is presented to us by Stockmark, and finally, if we are given multiple strategies, how to pick the best strategy. So this is the scope of this video, and there are a lot of features in Stockmark, so you can actually try backtesting in multiple ways, and all you can do is just click on the link in the description below and you can test it out yourself. And it is pretty simple to use, and I'm pretty sure you're going to figure it out yourself. And we are also going to discuss on certain features which will really benefit us in building strategies in the upcoming video. So now we'll be starting off with backtesting the most famous short straddle strategy. So whenever you hear people say short straddle and the system-based short straddle strategy, one thing that comes to your mind is the 930 short straddle. This 930 short straddle is extremely popular in the trading industry, and we are just going to backtest how exactly that is going to work. So to backtest, all you have to do is select the index you want to backtest, and there is also a default strategy given on the left side, but here we are going to build our custom one. So Bank Nifty is the index we want to trade with, and I'm just going to select option, call option. So I'm selling one at the money call option and one at the money put option, and I'm going to place a stop loss. So with Stockmark, you can place a leg based stop loss, or you can also place a target trailing stop loss, or you can also place a strategy based stop loss. So there are multiple things which you can end up doing, but we are going to keep this pretty simple. And you can see that there are also features like wait to trade, move stop loss to cost. But Here we are just going to use a simple stop loss. So when I click on stop loss, again you have further more features here, that is stop loss based on points, stop loss based on spot points, and etc. So here I am just going to select a simple percentage based stop loss and type in 50. So all we are doing now is shorting at the money calls and puts and placing a 50% stop loss. That means if you are shorting at 100 rupees, you are going to place a stop loss at 150 rupees. So after that, you are now going to select the time of entry as well as time of exit. So since we are doing the 9:30 short straddle, so you will be definitely entering at 9:30 and you will be coming out by 3 o'clock. So you can change this timing as well, but this is the most popular timing for 9:30 short straddle and we are going to keep it the same. And we are now going to just click on backtest. As I told you, there are other things like positional trades, protect your profits, so various other features, but this is a very basic setup. Just shorting ATM calls as well as puts and placing a 50% stop loss, specifying entry time as well as exit time. So I'm just going to click on backtest. So when I click on backtest, you can see that totally we are testing for close to 1800 days. So in this 1800 days, obviously not everything is going to be trading day. We are going to have around 1200 trading days and it is going to test for each and every day. So if you every day enter at 9:30 and exit at 3 o'clock with a 50% stop loss, what would be actually your profit or loss? So you can also add some slippages if you wish to, and you can also add the VIX level. Let's say some people are not comfortable trading when the VIX is above 15 or above 20. So you can also specify that if required. So in this, we are not going to do that. We are straight away going to move to the strategy summary. So this is very important because this is going to overall give us an idea of whether the strategy is going to work in the longer term or not. So first we have what is known as the overall profit. So we can see that by repeating this strategy every single day. So every day you come, log in, at 9:30 you sell ATM calls as well as puts, place a 50% stop loss and close at 3 o'clock. So if the stop loss is triggered, you don't have to do anything else. Just wait for the market to close. All that you have to do is just follow this every day and you would be ending with a profit of close to 5,53,000 if you had done this over the past 5 years. So if you do this with 10 lots, it will be somewhere close to 53 lakh of profits. And you can also see other details such as average day profit. This means on a daily basis, you have earned close to 451 rupees with one single lot. And it is also going to tell you the maximum profit, maximum loss, and you can see the probability of profit here. So totally out of all the trading days, 882 days you have been profitable, or this strategy has given you profit, whereas only 342 trading days or 28% of the times this strategy has given you a loss. So overall you have a profit probability of close to 72%. And trust me, this is an extremely good probability. And other things are pretty straightforward. The average profit on the winning day, average profit on the losing day, and the maximum winning streak, number of days no stop loss was hit, one stop loss was hit. So all this is pretty straightforward. So what is not really straightforward is the max drawdown, return to MDD, and expectancy. But these are certain important things which is going to tell you all you need to know about the strategy, right? So we are going to touch upon this later in the video, but before that we'll just come down and see what all Stockmock is going to provide other than this. So as we come down, we do get to see the monthly breakup where we can see every month how much this strategy has given. So you can see that in 2017, there was no month where the strategy actually gave a loss. In 2021, there are 2 months in which this strategy ended with a net loss. So this is again pretty straightforward. It is going to give you complete details as to how much this strategy has given in terms of profit or loss for every month. And as we further move down, we have two things here, the profit as well as cumulative profit. So profit is again going to give you a bar graph of every day. So how much you made or lost each and every day. And when you click on cumulative profit, so this is going to give you the equity curve for the strategy. So when I drag this back, you see when we started from 2017, we started with a 0 and slowly we started going up, up and up. And as we come towards 2020, we have made an overall profit of 4 lakh just using one single lot. And as we move towards 2021 end, just with one single lot, we have made an overall profit of close to 5,35,000. So this is something really amazing, and you can see that so easily we were able to backtest this entire strategy for 5 years each and every day. So people before were charging quite a lot to do this, and with StockMark you can do it quite easily. And as we further move down, you also get to see individual day wise. So January 2nd, how much was the profit or loss, and January 5th, how much was the profit or loss. You get to see this for the entire 2000 and odd days. Let's say I just come down and I pick July 9, 2021, and I can see on July 9, 2021, we had entered a 35,000 short straddle at 9:30, right? And 35,000 CE as well as PE have been shorted, and we can also get to see the price. So we shorted this at 365, we shorted this at 346, and none of the stop losses were triggered. So both traded, and this leg gave us a net loss of 762 and this leg gave us a profit of 3,350, and overall we ended with a 2,087 profit, 2,587 profit. And if there's a red color right over here, what we can see, this means on that particular day, the stop loss was triggered, and we will also get to see the time. At 11:44, this particular leg stop loss was triggered, and that day we ended with an overall loss of 818. So simply like this, you get to see for each and every day how much you made or lost, and at what price the stop loss was triggered, what strike you entered, and also at what time the stop loss was triggered. So you have all this data, what you are going to get just in couple of seconds when you actually backtest this strategy. So you can also modify this. Maybe you can put with 30% stop loss or 70% stop loss or whatever it is. And you can also modify the time of entry, and you can also place a strategy based stop loss. So you can work around this in quite a couple of ways, and you can definitely try it out. It is pretty simple to use, and I'm pretty sure you are going to figure it out yourself. So do click on the link in the description below to get some additional credits for your initial backtesting. So now moving on, let's say I create multiple strategies like this. So here we have a 9:30 strategy entry. Let's say I open StockMark in 2 more tabs and I create 2 more strategies. So let me go to home. Again, I'm going to short at the money calls as well as at the money puts. But this time we are going to place a 30% stop loss, and let's enter it at 1 p.m. So instead of entering this at 9, we are going to enter at 1 p.m., exit at 3 p.m. So this time all the change we have made is just with respect to stop loss. We have reduced it to 30%, and we are entering at 1 o'clock and exiting at 3 o'clock, and we are just going to do a simple backtest. Again, we will build one more short straddle strategy. Let's say this time we will just create a short straddle and place a stop loss of, say, we'll try to place a 90% stop loss, and we'll be entering this at 2 o'clock and will be out by 3 o'clock. So this way we have 3 different strategies now. So I'm going to backtest this as well. So now we have all the 3 strategies with us. So let's just look at the strategy statistics. So when we come over here, so what we get to see is this particular strategy has an overall profit of 5,53,000, whereas this strategy comes with an overall profit of 4 lakh. This is the 1 o'clock strategy, as well as the 2 o'clock comes with an overall profit of close to 3 lakh. So this is 5 lakh, 50, 4 lakh as well as 3 lakh. And you can also see the profit probability. This is 72%, this is 70%, as well as this is 74%. So now just looking at this data, which strategy do you think is better? So you're doing everything with just a single lot. So which strategy do you think is better? So when you're asked to choose between these three strategies, where one is coming with a profit of 5.53 lakh and the other one has 4 lakh and the other one comes with the overall profit of 3 lakh. So now which strategy do you think is better? So this has 74% probability. So would you go for the strategy where you're only getting 3 lakh with 74%? Or would you go with a strategy where you get 4 lakh with 70%? Or would you go with a strategy where you get 5 lakh with 72% probability of profit? So this is one mistake which people do, is they only end up focusing on the overall profitability of a strategy. So this is the same mistake even I did. What I used to focus on is, okay, just look at the overall profitability of the strategy. Whichever strategy has given the highest profit or the maximum profit, just go with that. But trust me, this is not the right way to do it. Okay, Saket, then what is the right way to do it? How do I know which strategy is better? So there are multiple ways to measure it, but the most simple way to pick the best strategy is this expectancy ratio. So the thing is, whichever strategy comes with the highest expectancy ratio, you can just use this single number to conclude that this strategy is better than the other. So how exactly is this expectancy going to work? So we are going to discuss more about that later on in this video. So all you have to know is, don't really bother about the overall profitability or your probability or even your maximum winning streak or how many days the stop loss was triggered. So just focus on this ratio alone. And the other most important ratio is the return to max drawdown. So we'll cover it in the next part, where we are going to discuss what exactly is a drawdown, as well as we are also going to discuss about what is return to max drawdown. So even this is a very important ratio which is going to help you to understand risk side of the strategy. So you're going to understand in the worst case scenario how the strategy has done. So that is what the drawdown is going to tell. Here, as I already told you, give more importance to this expectancy ratio, and whichever strategy comes with the highest expectancy ratio, that strategy is the better one. In this example, so we have three strategies, where the first strategy, even though it has 5,53,000 profit, it has an expectancy of 0.24. So this has 4 lakh profit, but comes with an expectancy of 0.31, and the other one has 3 lakh profit. This is the 2 o'clock entry, and it comes with an expectancy of 0.36. So now which strategy are you going to pick? Pretty simple. So you are going to pick the strategy 3 because that is more superior to strategy 1. So now you might ask me, Saket, what exactly is this expectancy, and how are you telling me that strategy 3 is much superior to strategy 1? So now we'll use a simple example to understand what exactly is expectancy. So for example, let's say we have a strategy named X, right? So this strategy comes with a profit probability of 50%, which means the loss should also be definitely 50%. So this is profit loss. So it comes with a 50% profit probability and 50% loss probability. And next is the average loss as well as average profit. So average profit, let's say, is somewhere close to 1,500 rupees. So whenever you make a profit, on an average, you're going to make 1,500 rupees. And the average loss is 1,000 rupees. So whenever you are going to lose some money, you are going to lose 1,000 rupees. So this is the data which you are already going to get in your backtest result. So you can see the average profit on win days, losing days, as well as the total probability of winning is to losing. So now the thing right over here is, let's assume in this strategy X, it comes with an average profit of 1500 and average loss of 1000 rupees. So now if I say what is the expected profit for me in the next trade, that means let's say I take one more trade tomorrow, that is 25th of December, what profit can I expect on 25th of December? So for this, all I have to do is multiply the expected average profit, which is 1500, into the probability. So probability is 50%. So this is the expected profit minus the loss what I am expecting. So I am expecting a loss of 1000 rupees into 0.5 because the probability is 0.5. So this is nothing but 750 minus 500, which is equal to 250 rupees. So on an average, I can expect to make around 250 rupees the next day I take a trade. I hope this is clear. Let me just quickly brief this once again. So I have a strategy X where it has a probability of profit of 50%, probability of loss of 50%. And when I make a profit, I make average of 1500 rupees. And when I lose, I'm going to lose around average of 1000 rupees. So my expected profit, so let me just write this down. Expected profit is going to be the probability into average profit minus the probability of loss into average loss. So this is going to give us 250 rupees. So now let me just draw a line here just to separate this part. So we know that the expected profit is nothing but 250 rupees, right? So what is the average loss I am having? So the average loss is 1000 rupees, right? So that means to earn a expected 250 rupees, I am going to risk 1000 rupees tomorrow. 250 is my expected profit. To earn 250, I am risking 1000 rupees. So because my average loss on a losing day is 1000 rupees. So what is my ratio? Ratio is nothing but 0.25. So if the ratio is 0.25, it is just meaning that if you are risking 1 rupee, your expected return is going to be 0.25 rupees. Let's say we are now going to talk about a strategy Y, right? So now let's say the expected profit of strategy Y is somewhere around 1000 rupees and the average loss is somewhere close to 2000 rupees. So this time my expectancy ratio is going to be 0.5. So that means I am going to expect a profit of 0.5 rupees for risking a single rupee. So every time I risk 1 rupee, I am expecting a return of or expected return of 0.5 rupees. So this is a very simple ratio and I hope the meaning of this ratio is very clear. So the expectancy ratio is going to tell you nothing but for every rupee you risk, let's say you're risking 1 rupee, how much is your expected gain? So the higher the expected gain, that means the more better the strategy is. Because let's say for risking 1 rupee, one strategy is giving you 0.3, whereas the other strategy is giving you an expected return of 0.2. So you would obviously go for one giving you the higher return. So same way in StockMark, you can see right over here. So the strategy 1 comes with an expectancy ratio of 0.24. So what exactly 0.24 means? So that means for every rupee you are putting to risk, your expected return is 0.24. So in this case, for every rupee you are putting to risk, your expected return is 0.31. And in the third strategy, every rupee you are putting to risk, your expected return is 0.36. So pretty easily you can just pick this particular strategy where you have the higher expectancy ratio. So all you have to do is, if you want to earn the same level of return as the strategy 1, just increase the quantity, and with lesser risk you will be able to increase your return. So end of the day, it is all coming down to taking lesser risk to increase your return. So in this particular strategy, you can actually end up increasing the quantity and keeping the risk lower to match this particular profit. Instead of going one lot, go two lots. So now I'm going to show you what exactly will happen when you end up going two lots. So again, you can see the ratio here hasn't changed at all. So these two still remain to be the same. But what exactly has changed? So how am I telling this is better than this particular strategy by increasing the lot size? So I am able to tell this because here you're earning 6,25,000, here you're earning 5,53,000. But this is more superior because for the reason that you see the average loss on losing days is only 1,400 rupees, whereas here your average loss on losing days is 1,900 rupees. But more important than that is your average daily profit. Using this strategy, you are able to earn an average daily profit of 510 rupees, whereas here it is just around 451 rupees. Here the average profit for the first one is 450 with an average expected loss in a day of 1,950, and for the strategy 2, the average expected profit is around 520 with average expected loss of 1,400. So now if I tell you that you have to risk 1,950 rupees to earn 450 rupees, on the other hand, I tell you you have to risk 1,400 rupees to earn an expected return of 520 rupees, which one would you choose? The answer here is pretty straightforward. You would choose this because you're risking lesser but you're earning more. Here you're risking more but you're earning less. So it is as easy as it looks. This is how expectancy ratio can be used to choose a pretty good strategy. And again, Stockmock has various different features which you can definitely check it out yourself and you can try them out as well. So don't forget to check the link in the description below. And this was the introductory video where we just learnt about one concept which is really important for us to know about. So initially I also made this mistake of trying to go for one with highest overall profit or the highest probability. But later I learned that what I was doing was completely wrong. So I'm doing this video so that when you backtest, you also don't end up making the same mistake as I did. So with this, we also come to the end of this video. And if you have liked the video, then don't forget to hit the like button, share this video, as well as subscribe to Optionables. Thank you so much for joining, guys, and I'll be catching you soon in the next video.